Welcome to the Hello Harvest Economic Institute webinar on the debt ceiling, reining in the Leviathan or mutually assured destruction. My name is Kjetil Storsletten. I'm happy to meet you. Glad to see so many people here today. We are gathered here today because the federal government of the United States of America is about to hit the debt ceiling. We will discuss whether it's a good idea or a bad idea for the US to have a debt ceiling, and what are the consequences of hitting that ceiling and possibly default. We have three panelists with us that are among the world's leading experts on fiscal policy and default. Let's start out with Professor Chris Phelan, a professor of economics at the University of Minnesota.
Hello, everybody. So I'm going to just start by giving some history to this situation. So right now, and give actually a couple of hokey stories. Right now, our federal government deficit is around 5% of GDP in a time of peace and no recession. We're currently spending about 128% of our revenues. So I want to argue that our current situation, even if you get rid of the whole idea of hitting the debt limit, we're doing an unsustainable path right now. The debt to GDP ratio is actually not growing right now because of inflation. Because when you have inflation, you're actually devaluing all the debt that you have. But it's not going down either. So eventually, if we want to stop having so much inflation, we're going to be back to having a debt to GDP ratio of it's currently about 120%. The markets seem okay with 120%. They seem to be okay with Japan at about 200%. But there is some limit. You can't have 100 times your GDP in debt. And nobody knows where exactly the limit is, but there's some limit that the world imposes on you as opposed to Congress. And then there's really nothing you can do. The next thing I wanted to say is that debt ceiling negotiations and brinksmanship is not a new thing. There was a big crisis like this one in 1985. The Treasury had to do the kind of things that they're doing now, because they said they actually hit the debt ceiling in January and are doing technical things to keep from going over the statutory debt limit. This has happened not infrequently. The one that's closest, I think, to what's happening now is 1985. And in some sense, this is to be expected given divided government. I just want to give some history. It used to be that Congress authorized every single debt auction. They would say, because it says right in the Constitution, Article 1, Congress is the one that has the right to borrow. And they used to take that very seriously and say, we authorize the Treasury on this date to auction this many government bonds with these terms. They said the coupon payment, everything about them. Then they decided that that was too cumbersome on Congress to just pass every detail of every debt issuance. So they said, okay, Treasury, you can do whatever you want, just as long as you don't borrow more than this. So that's where the debt ceiling came from. It came from delegating the specifics of debt issuances to the Treasury, but not the total amount. The only idea I want people to get from this is, I don't know, I'm involved in the condo association. Where we are is like having a condo association that is spending, including loans that on payments for the loans that it's already taken out, 28% more every month than what's coming in the assessments from the owners. The board, up to now, the board president has been taking out loans to cover this shortfall each month. But the condo association has said you're allowed to take out loans, but not more than $100,000 or some limit. And you can't get new loans unless the entire board authorizes it, not just the president of the board. And they're up against that limit. So you're up against three things that can't coexist. The board is not authorized taking out any new loans. The board is not done the equivalent of taxes and said that you can increase taxes. They haven't done anything to allow more money to come in to pay the bills. And they've also told the board president to do these certain payments. And they just don't add up. So right now, the 14th Amendment says you got to pay the payments on the debt. There's plenty of money coming in every month to pay the payments on the debt. But there's not enough to make the payments on the debt and do all the Social Security spending, military spending, parks spending, everything. We just add up what we're spending every month as a government and what's coming in taxes. Again, we spend 28% more every month than what's coming in roughly. So then the problem is the condo board in my little example, or Congress and the president in real life, everybody knows that you can't continue to do what you're doing. You literally don't have enough money to do everything that you're supposed to do. They can't agree on what to do with it. I just want to then bring a few more facts. We really do have a lot of debt. It's about $75,000 per person, and it's about twice that per worker. All right, so having $150,000 of debt owed to the federal government owes about $150,000 per person. That's a big amount. But more to the point, most of the reasons that we economists say that it makes sense for a government to run deficits some year, surpluses other years, is almost like rainy day type analogies in families. You run up the debt during you pay down your debt during sunny days or even save during sunny days so that you can borrow or run down your savings during rainy days. The problem is right now we're doing this spending $128,000 for every $100,000 that comes in sunny days. We're not in a recession. We're not in a war. We don't have the COVID crisis right now. This is the time we should be saving, not massively borrowing. And the future in terms of revenues doesn't look good. There's what's known as the dependency ratio, which is just the fraction of people who are working or the age to work versus the fraction of people who are not. And we're getting older and we're not having as many kids, but in balance, when you look at that, the number of workers per retired person keeps going down. This is the time we should be paying down the debt, not increasing the debt, because taxes in the future are going to go up in almost any scenario. They're going to have to go up even more because we're going to have to pay off this debt. Just for me to wrap up, I didn't come up with the title, Reining in the Leviathan or Mutually Assured Destruction. The next speaker, Marco, did. But I really like the title. I think the answer is that we're possibly doing both. So one reason to have a debt limit is it helps in the kind of negotiations with the condo board or the taxpayers versus the executive or everything, to have some limit. You actually have to come into agreement every now and then about what we're going to do, because it's just like it's easy for a family to say, okay, we're not going to have this fight tonight. We're just going to put it on the credit card. Congress can avoid fights like that just by putting it on the credit card. It's not good. This is a time we should pay down our debts, not adding to the credit card. But sometimes it's just natural in the political system to add it to the credit card in order to push the fight down the road a little. But yes, we are risking mutually assured destruction if we stupidly don't pay the debt or don't make the payments on the debt when the Treasury runs out of tricks to keep them from violating the statutory debt limit. So I'm going to just finish up in my last minute by saying, well, who do I blame on all this? Do I blame the Republicans or do I blame the Democrats? I blame the American people. There's no constituency in this country for fiscal sanity. You have one party saying you can have high government and low taxes, and another one's, there's one party saying we can cut your taxes and it's not a problem. And the other one says we can raise your benefits and it's no problem. The American voter is convinced that it can have a European-sized government with relatively low taxes on the middle class compared to Europe. Anyone who proposes European-type taxes on the American people loses, and anyone who proposes having benefits that correspond to our taxes, having benefits for the middle class that correspond to our taxes on the middle class, also loses. So at some point, the American people are going to have to decide that you just can't do everything by cutting foreign aid. You can't do everything they want to do by only taxing billionaires. There just isn't enough money there. If you want to have European-style benefits, you're going to have European-style taxes. Or you can have American-style taxes and not have European benefits, but you can't do European benefits and historically American taxes. So I'm kind of done. I believe up next is.
Thank you.
Shuttle, go ahead.
Thank you very much for that. I must say I am a bit more optimistic on behalf of the American people, but there was you alluded to an important and a bit scary issue: the mutually assured destruction, hinting back to the terror balance of nuclear war. The next speaker, Dr. Marco Bassetto, monetary advisor at the Federal Reserve Bank of Minneapolis, is going to tell us something about that.
Hello, everybody. Good afternoon. Thank you for joining us. I should start by mentioning that everything that I say is strictly my own opinion and does not reflect necessarily the views of the Minneapolis Fed. So I want to start reiterating something that Chris already touched upon. So this is in pictures what the surplus or the deficit, so surplus when it's above zero, it's a deficit everywhere else, that the federal government has been running as a percent of GDP. So you can see a very large drop during World War II, not surprisingly. It was a tragic period. Lots of resources were spent in fighting the Axis, and the government relied a lot on borrowing for them, sharing the great sacrifice that that generation did with the future generations. Since then, you can see that what the United States has been doing since the financial recession is unprecedented. And one of the things that you want to keep in mind is what we call the Great Recession of 2008 was great, but it wasn't greater than what happened in the early 80s. And you can see that the deficit was much smaller back then and wasn't greater than some of the recessions that the United States had in the 70s. What happened with COVID was definitely the biggest shock that the US economy had since World War II, but it was very short-lived. As Chris mentioned, the unemployment is back to levels that are historically low. Certainly some sectors were hit in a persistent way. Think about leisure and hospitality, they're recovering right now. But overall, for the economy, it was a sharp but short-lived phenomenon. The deficit was not short-lived, and we're still at levels that essentially we had never seen, except maybe for a year or so of the Reagan administration, back when people were worried a lot, in fact, about deficits. Other than that, they're unseen since World War II. Now, part of what economic theory tells us about this, so we have a significant number of political economy papers that suggest that an environment of political polarization will deliver this. And intuitively, the reason is if you have two parties alternating in power that strongly disagree on priorities, each one of them is going to try to promote as much as possible while they empower their priorities and leave the next party broke so that they cannot implement their priorities. So that's one possible explanation why we are seeing bigger problems than we have in the past. I want to briefly talk about ways in which economies have been dealing with this problem, because of course overborrowing is certainly not something that is unique to the United States. In fact, many developing economies have had big default problems that the United States so far has not faced, at least since the 19th century. So one option is outside pressure. Sometimes in periods of debt crisis, countries have called upon the IMF to provide them with help. In Europe, the Maastricht Treaty imposed some limits, not terribly enforced, I must say. But that's sort of a way of getting the commitment to fiscal responsibility through an outside party. I don't think that's a viable solution for the United States. So this is probably not the way to look for. At the state level in the United States, almost all states have a rule that is typically in their constitution that we call the golden rule in economics, that says that you're only allowed to borrow for capital projects. That's a tough rule. Now, there's, as you can imagine, creative accounting around it, and states differ in the amount of creative accounting that can happen, but that's one way of enforcing fiscal discipline. The federal government has none of that. It has tried in various ways of dealing with this. So in the 80s, there were a couple of acts called the Gramm-Rudman-Hollings Acts that were designed to trigger automatic sequestration, so reduction in spending if Congress did not agree on respecting some pre-specified spending and deficits parameters. These were modified. There were a couple of acts in the 90s, the Budget Enforcement Acts, that worked in similar ways. But since the early 2000s, those are gone. And essentially, there are right now there are two ways in which fiscal responsibility partly shows up. One is through the annual budgeting process. And as you probably know, if there's no agreement between Congress and the president, we end up with a temporary government shutdown until they do agree on spending. And the other is the debt ceiling that we're talking about today. Now, the difference, there's an important difference. Let me first mention one thing. So these are, they're not constitution, they're not part of our constitution. So they're relatively easy to change. So these methods of imposing some discipline are not that effective. In particular, they're only effective when you have divided government, because that's where, there are really two factions that have to agree. When you have one party in power, there's nothing that prevents that party from just ignoring or routinely increasing the debt ceiling or passing whatever budget according to their priorities. So that's important to notice. If you go back to the picture that I've now taken out, the big period of surpluses happened in the 90s when Clinton was president and the Republicans controlled the House. And in that period, we had somewhat one of the longer government shutdowns too. And part of that just shows you the divided government along with these institutions is a way in which fiscal discipline has happened in the past. You can sort of see it also at the level of the state in the state of Minnesota. So last year we had divided government, we had a record surplus and it was not spent. This year, we don't have divided government and the record surplus was spent. And I'm not saying whether that's good or bad. As I mentioned, the state situation is very different because they do have tight constraints that don't apply to the federal government. Now, I want to focus quickly, because I'm running out of time, on a key difference. The budgeting process and the threat of government shutdown is sort of a mild threat. You know, a shutdown of governments of 2 weeks is somewhat disruptive. It's certainly very disruptive for some people if you need a passport urgently, but it's macroeconomically, it's not a big effect. The debt ceiling is a much bigger problem. Potentially, we don't really know what's going to happen. And so that's, you know, potentially it's a catastrophic outcome. It's going to go into the courts. Exactly what can be done is not clear. So if you're thinking about bargaining, this matters. So the more dire the threat is, and that's where you know, nuclear war is an example of bargaining across superpowers comes in. We never had nuclear war, thankfully, and part of it, we didn't really have a direct war between the Soviet Union and the United States, and part of it is associated with the idea that mutually assured destruction meant that people realized that it would be a very bad idea. And so, whereas we've had plenty of government shutdowns, all of them fairly brief, we've never had a default triggered by the debt ceiling. That's partly reassuring. What I think is concerning, though, is you know, we had the Cuban Missile Crisis, and yes, people agreed, and nothing happened. But do we want to really re-experience that? We certainly don't want to be in the situation in which something catastrophic happens. And what makes life a little more complicated at the moment, in my opinion, is that it's not the Democrats bargaining with Republicans only. It's also, there's razors in thin majorities for either party in either house. And the two parties are somewhat split between factions. And the more people you have to agree at the bargaining table, the bigger the danger that something is gonna go wrong. And so my conclusion is that debt ceiling may be a useful tool to force a budgetary adjustment, but it does come with some big risks of miscalculation that we need to think about, and maybe alternative mechanisms might be less risky.
Thank you. That brings us to the last speaker today, and I'm in Oslo, so it's actually night there. What would happen if we were to go down that road and actually default? Dr. Cristina Arellano, monetary advisor at the Federal Reserve Bank of Minneapolis. Why don't you tell us?
Thank you, Shetel. Thank you, everybody, for being with us and discussing this interesting and important topic. The history of sovereign debt and default over time and across many countries is rich. The United States has never defaulted on its federal debt, and the talk of a potential default of US debt is unusual. In my remarks, I want to stress 4 main points. First, I will argue that sovereign default is common in many countries in the world and can be very costly. Second, high debt tends to obviously increase the probabilities of those defaults. But that doesn't mean that using government debt is useful. My third point is that while it's true that in the United States, government debt is as high as it's probably ever been in the last century, at least, the interest payments on this debt are, in fact, not so high, and they are lower than a few decades back. And my fourth point is that sort of the lack of progress on negotiations of the debt ceiling threatens possibility, this benefit of the United States to be able to pay such low interest. I should also say that the views here are my own, and those are not of the Federal Reserve System. So going to my first point, we have been studying sovereign debt crisis for quite some time, many of us, and there have been many defaults, especially in middle-income countries. To give you an idea, Since 1970, we've experienced about 60 sovereign defaults across 30 middle-income countries. You can think about Argentina, Ecuador, and others. These defaults are costly. So just to give you again, there's a classic example that we look at when we think about sovereign default, and that's the Argentinian default in 2001, where the default triggered a very large spike in dollar interest rates. Interest rates just went to the roof to over 20%. There were large collapses in economic activity of GDP of more than 15%. And some other defaults are maybe less dramatic, but the consensus there is that a sovereign default is costly. Now, not only sovereign default is costly, but the risk of a sovereign default is costly. And the European debt crisis of 2011, it provides us a great example of that. So, for example, countries like Italy and Spain did not default on their sovereign debt, but there was this risk that they might default. And interest rates on government bonds on these countries in 2011 increased in the peak of the crisis to about 5%. So, a 500 basis points. This sort of increase in spreads generated costs for the economy. There were generated panics in the financial sector, a credit crunch, and contributed to a decline in economic activity. So, in summary, the risk of default and actual defaults are costly as the interest rate on government debts increase and the financial system becomes threatened. Now, to my second point, this is not to say that the governments, should not borrow. Debt is useful, and both Chris and Marco discussed these benefits of using debt. This sort of a standard principle there is that governments should use debt to smooth tax revenues and respond to shocks. The COVID pandemic is a great example of this. During the COVID-19 pandemic in 2020 and 2021, the G7 countries were able to really use their debt to support their citizens. Their debt increased on average by 30% during those two periods. And countries like emerging markets, that have much limited fiscal space, were not able to use this debt to support their citizens. Countries like Argentina, Brazil, India, Indonesia, Mexico, South Africa, they increased the debt by only about half of the one seen in advanced economies. Now, I want to maybe share with you a graph for my third point, which is that government debt has not, we have not seen, so this is just a picture of the US government debt. So the black line, this is what we're discussing about. Debt to output is over 100% now. Since in 2080s, it was less than 50%. So for sure, debt to output in the United States is very high. What I want you to focus on in this graph is this red line, which is the interest payments on the debt. So how much the federal government has to pay in interest for this debt, actually, if you see here, has declined from about 6% of output to about 4% of output. Okay? And the reason for this is precisely that interest on the debt has declined over time, partially because of this large global demand for US government bonds. The whole world uses the dollar as the reserve currency. They have this large demand on this debt because of the safety and liquidity properties of US treasuries. And this means that it is actually perhaps not as costly for the government to have this debt and service this debt because interest rates have declined. So I want to just conclude here in my last point, which is the fact that one potential problematic piece of this lack of progress on the negotiations on the debt ceiling is that it threatens this large global demand for US treasuries. And this sort of threat could be potentially costly from a fiscal perspective. If global and domestic investors suddenly fear that there might be a potential US government default, they might run away from treasuries into other assets, government, European bonds, Japanese bonds, corporate bonds. And these, of course, would increase the interest rate that the US government has to pay on its securities, which would be detrimental also from a fiscal perspective. So to conclude, I want to say that the United States has a unique advantage in the world, with the dollar being the reserve currency. This is very beneficial for our society, and I think it's is a risk that these debt ceiling negotiations are threatening. Thank you.
Thank you. Perhaps all the panelists can come on. So thanks for this. Let me just we're going to open up for questions from the audience. But let me just start with the last thing you said, Cristina. So it's true that the United States has a very low interest rate, but the other arguably the other Western countries also have had very low interest rates over the last decade. Some people say that we're in a new situation where the interest rate is really low, and therefore perhaps we shouldn't worry about debt, the large debt. What's your view on that?
I think that the fact that the interest rates are so low is an advantage in a situation when you have a lot of debt, because what you have to pay in order to service the debt is not that much. As I showed you, it has gone down relative to the, let's say, early 1990s, where while the government debt was half. But it does not mean that the interest rates will remain low if the government, for example, of the United States would increase the government debt to GDP to, say, 500%. Okay. So if you would increase that amount of debt, you would naturally think that interest rates will have to rise in order to give incentives to these investors to hold that debt. So right now it's helping us, and perhaps on the margin, it's been not as costly to have a debt to GDP output of over 100%. But it doesn't mean that we should just sort of let it run, and that interest rate will not change if the government increases the debt even more.
Good. I want to give each of you a chance to comment on. So first of all, I have to say to the audience, you can write if you like to ask questions or make points. You can go into the Q&A, and I believe it should be open for asking questions there. I want to let the three of you comment further on each other's talks, but let me just ask Chris and Marco a question first. So when Congress decides on taxes and spending, in principle, they could at the same time just decide on a debt ceiling that's consistent with that. So from that perspective, the debt ceiling shouldn't give any guardrail, provide any guardrail. But still the Congress chooses to not lift the debt ceiling at the same time as they decide taxes and spending. Why? What am I missing?
So can I jump in, Marco? I'm gonna end on what the American people want, which is inconsistent things. So the last time the debt ceiling was raised, I believe the House, the Senate, and the presidency were all in the Democratic hands. Why didn't they raise it to 50,000 trillion? They could have. They didn't need any Republican votes to do that. During the Obama administration, there were times when the Democrats owned everything. There were times when the Republicans owned everything and they could have raised it to 50,000 trillion. They choose not to because that's seen as paying, I believe it's correctly seen by the politicians, is that they will pay a political price for doing that. So what the American people want, though, is, this is what they voted for. They want a situation where there is a debt ceiling, and they voted for divided government. And so you get into this situation where, and they want things that don't add up. You know, a certain level of spending, certain level of taxes, where the spending is above the taxes. So eventually you're going to hit the debt ceiling. So that, I mean, the reason why they didn't get rid of it earlier is because they saw a political price to doing so. Marco?
So I think my impression is the fact that we have these two separate arrangements is a little bit of something that arises from history. It's a quirk of history. Chris mentioned a little bit how it came about. But it doesn't seem necessarily good or bad per se. So, you know, we now have two safeguards against excessive fiscal profligacy. That by itself may be good. Now, there are issues, and I think Cristina talked a lot about them, both the cost, direct cost, if the US does default, and the fact that the longer this goes on and the closer we get to default, and if people start being seriously expecting that this is an option, there are costs that we're bearing just in anticipation of that, not just when that will happen. And those are valid considerations, and they come from the fact that you don't want to get brinkmanship too far.
Let's take some questions from the audience. There's a question from Hayrev Ramesh, asks, should Congress have a limit on fiscal deficits instead? Marco, you mentioned the euro area, where they have a limit both on deficits and the debt. What is that? Would that be a better idea than the debt?
So Grand Rudman Holdings was about limits on deficits, and I think now the Budget Enforcement Act, I believe that also was on deficit limits. So you can have both. I think the key is to have some mechanism that prevents whoever is in power on that day just to neglect the long-term consequences of their choices. Ideally, it would be something that is well understood, it's simple, and ideally the parties bargaining understand each other well, because that is going to avoid the risk of unintended consequences. But, you know, we don't live in an ideal world.
Can I jump in and ask another question that goes in the same, I don't know if Chris might want to say something, but that go in the same line. The question is from Kurt Winkelmann. Suppose that all agree on the economics of measurements or on management of government finances. If so, then the main issue is, as Chris has pointed out, political. Marco brought up the idea of mechanisms. My question is, what would an ideal mechanism look like? I suppose that the corollary is how far away from that idea we are now. Chris?
Well, you know, when HHEI does these things, sometimes I feel there's too much agreement among the economists. So I'm going to throw something out that I know Marco and Cristina are going to disagree with. I like to use analogies like I use the analogy of the condo association. There are some people that just can't handle credit cards. And every financial, credit cards are great. One of my colleagues, Kyle Herkenhoff, just said, you know, people use them now when they didn't really exist much before the 80s. People use them now when they lose their job. They get lots of benefits from smoothing their consumption in bad times, you know, eating more than their income in bad times by going into their credit cards and then paying them off later. And some people can handle credit cards, other people can't. And financial advisors tell them to just cut the things up. They lose all the benefits associated with credit cards, but at least they don't go bankrupt. And so my personal thing is rather draconian. We should just I wouldn't mind if there was a constitutional amendment right now that said the debt limit is $1 trillion higher than it is now. And that's it. You're stuck with it, even in nominal terms. And not because I disagree that there are benefits to being able to use deficit spending in emergencies and so forth. It's just that, just like for a family that can't handle their credit cards, the benefits are outweighed by the costs, which is exactly for what Marco said. We have this equilibrium that Person and Tabellini talked about, which is each government, when they're in power, wants to spend on what they want to spend on and leave their successor broke. And it just causes a debt, it's causing, we can see the debt to GDP ratio now is twice what it was, 15 years ago? We're in a bad situation. I wouldn't mind cutting up the credit cards. That's my mechanism to answer Kurt's question.
Cristina, what's your favorite mechanism? Or you muted?
I'm surprised, Chris, for your proposal, because I think that the state contingency part of the mechanisms are so useful in most of economics. So this idea of an uncontingent debt ceiling in nominal terms, seem sort of extreme in the context of optimal contracting. And I also want to say, the issue with, just going back to a little bit emerging markets and maybe thinking about the United States, is that the market does provide a disciplining mechanism. Okay, and I'm sympathetic with what you're saying in terms of the political process being problematic for over borrowing, but the market. When governments in emerging markets or maybe even the United States, when they want to borrow a lot, then interest rates increase, and that gives already a discipline mechanism for the government to not borrow as much. And in the United States, we are very, very far away from that. So it is sort of not a market mechanism that is disciplining, that is present, but actually it is political mechanism, and I'm completely agree with you that it is sort of a decision in terms of what the American people want the finances to look like, but just to think about the state contingency, I think that 100% of GDP of debt is a lot, okay, but at zero real rates, that is not that much.
So the Chris's Molotov cocktail has triggered activity here on the net. So and I think at least I have a point there. So one attendee writes, I'm constantly hearing politicians talking about how we need to act like a household and balance our budget every year. Is the household really a good analogy of the country? Cristina alluded to an important issue, namely everybody out there, they want to use American dollars the American dollars is the backbone of the financial system. When a person in Mali wants to trade with a person in Norway, they trade in US dollars. So US dollars provides liquidity to the market. The market loves liquidity. The financial system needs it. A household, I wish I could issue my own currency. Nobody's going to buy them. So that brings me to perhaps the other extreme would be to just deposit $1 trillion coin into the treasury, as Gavin Johnson asks here in the net. Chris, take that.
Can I just make a quick thing, and then Marco, who's really the expert on this, can correct me if I'm wrong. So I actually do think that thinking about these things in terms of households is close enough to being right to make talking about it in terms of households useful. Is it exactly right? No, households can't print their own currency. Households don't have to pay their debts off. I mean, the US government has an option if it can get the Fed to go along. And again, I consult for the Fed and just talking for me, not the Fed. If they get the government along, that every time they needed to make a payment, they could just make the payment by printing new dollars. Households can't do that. The problem is people take that too far. Christina is absolutely right that there's a kind of a free lunch for Americans by the fact that the world wants to use dollars and the world wants to save using United States treasuries. We get kind of a constant flow of free stuff from the rest of the world because of that. But it is a finite flow. It is not that we can do whatever we want. We don't need to tax that much, right? It is a finite flow, and I actually don't think it's huge. It's big, but not, I don't know what that means. It's big, but not huge. So that's why I still use the household analogies. You kind of have to think of it, maybe the right household analogy is you're a household that's spending more of your income, but some of that income is a constant flow from an inheritance or something like that. The household analogy works. But yes, it is the case that having the reserve currency and being able, and everybody wanting to hold US treasuries is kind of a constant free lunch. It's just not so big it gets us out of all of our problems. Marco?
I think you said it very well. So yes, I mean, the government has some special revenues. They're not infinite. You know, if you put together what Christina said, what Chris said, what I said, you can see that we've been in a very special period. You know, I pointed out how deficits are somewhat unprecedented, but Christina showed you that interest payments are historically very low. And the debt to GDP ratio has come down recently. And that's because in real terms, after inflation, we've been paying terrible rates to whoever lent to the federal government, to the negative several percents. The question is that something that we can sustain for the future? It's certainly unprecedented. I mean, there's quite a bit of research thinking that safe interest rates may have come down, but I don't think anyone would be ready to think that they're going to be minus 5% going forward. And if they're not that, then we're going to need to make some adjustment at some point, and that adjustment will very much look like the adjustments that a household would have to do.
Can I just, I really agree with that. But can I just say one thing? Imagine, in some sense, I would claim that we don't really know why the interest rates have fallen so much. They've fallen really a lot since 2000. And at the moment, they looks like they're going to stay low for a long time. But if we don't know why they came down, it's going to be hard to, it's hard to say that they couldn't go back up. And it would be sad if they went back up, if we build up a huge debt and see the interest rate rise precisely when a lot of people are, go for retirement.
Can I answer something you're saying? So I just want to comment on this. So there is some evidence from these emerging market debt crises that default risk can change things very, very quickly. So there is this sort of long-term trend of the real rate of the rates coming down, which you're saying, well, they might, there's some factors that are predictable. For example, demographics. Demographic is one reason why interest rates have, come down, and that's expected to persist. But sort of if there is a risk of there's chatter, there's a sort of a fear that the U.S. government is going to default, that could change very quickly the appetite for those treasury bonds. And so that we don't want to get into that scenario, obviously, but I just want to say that sort of this idea that interest rates are going to remain low, that is under this confidence environment that we want to protect and we want to continue.
A question from Ray Carter. If you're in the room with Biden and McCarthy what would you advise to reach compromise? Anybody willing to speak on that?
I think that's a very difficult question because we all have our own politics. So my answer would be, please do whatever I think is my current. So as an economist, the answer would be agree on something. As a voter with my own preferences on what happens to the government is, please do exactly what I want you to do. And I find it hard to separate those. And just agree, we all know is kind of useless. You know, so you can't just tell people to just agree, because at the end, the question is always agree to what? Because they're both going to look at you and say, I agree, we should agree. He should do what I want.
When we're on the politics, here's a question from Mark Zashin. Does the 14th Amendment really help at this time of the political stalemate? And the one who answers it, please explain what is meant by the 14th Amendment.
Waiting for Marco or Christina to jump in. I'll give a quick thing. I don't think it helps. The 14th Amendment does say that you can't question the government debt, which is interpreted as you got to make the payments. It's unconstitutional for the government to renounce its debt. I don't think that helps resolve anything, because the power to make new debt is with Congress, not the president, just like the power to tax is with Congress and not the president. I mean, one way to solve this is just to raise taxes. But again, you need the Congress to pass something to raise taxes, and the president has to be willing to sign it. Same with raising the debt limit. You need Congress to be willing to pass something. The House has, the Senate hasn't. And it has to be in the form that the president's willing to sign. I don't think the 14th Amendment really applies, other than it has a little thing, which is, suppose that they said, well, look, we're going to do it anyway. We're going to just increase the debt. It does say lawfully issued debt shall not be questioned. And so I would worry about purchasing debt, that if they said, look, I don't care if it's over the limit, we're just going to do it anyway. I would worry about purchasing that, because a future government could say 14th Amendment doesn't apply because this wasn't lawfully issued.
Here's a question from Vivi Chari. A long-standing principle of public finance, and in times of peace and relative prosperity, fiscal policy should reduce debt relative to output. Are we anywhere near that dictum, especially given the demographic time bomb we anticipate?
I think we all said no. I think that's fairly clear, and that's part of the concern here. I would like actually to mention something about this in relation to the fact that we have low interest rates. To me, the fact that we have low interest rates and we don't, I mean, we have various theories, but it's not settled what is causing them, is an issue of concern in itself. Because, you know, people, so we have sometimes negative real rates, but, you know, people want to get mortgages, they seem to be impatient, people run credit card balances. I don't see people so desperate to save. And that tells me that there's something in financial markets. So the US treasuries have this special role. And somehow intermediation between those borrowers that would have good use for funds, they would like to buy houses, they have projects and so on, and savers that like to save, is not working as well as it could. And so just saying, oh, it's great that we have low rates, it's great for government finances, but it does say that maybe there's something that is an issue.
I sense that the three of you actually are pretty happy about the debt ceiling. That we should be glad that we have it, because you think we need a guardrail on fiscal policy, or not?
It has benefits, but of course, I don't want to. This is a bit too strong. It's like saying I'm happy that we have nuclear weapons because we never use them.
But with nuclear weapons,
end up using them.
I think if we could press on a button and remove nuclear weapons, I think we'll do it. But we can't take away that limit. We can't take away nuclear weapons. Sorry, they are invented. But we can take away the debt limit, and instead just focus on agreeing when we set taxes and spending. But you defend it.
Well, Marco brought this up. Most states have something like a balanced budget amendment. They can't spend more than they take in, except for capital projects. If they're going to if they're going to build a new highway system in that state, they can borrow for that. And the idea being that it is true that you're passing the costs of paying those bonds back to future taxpayers. You're also passing the benefits. They get the road back then too. And they kind of want to match the benefits to future taxpayers to the cost to future taxpayers of debt. They seem to work out okay in my perspective. And so all of us agree that there are benefits to being able to have debt. What Professor Chari talked about in terms of standard fiscal policy. I guess my thought is that, yes, I agree that it's about magnitudes. My thought is, and in fact, this applies to, I think, to developing countries as well. Whatever benefits they're getting from using international capital markets so that they can spend more in a year than they're bringing up in taxes seems to me to be dwarfed by all the drama that it's caused by having sovereign default. So it would be better if they just couldn't borrow. But that's a quantitative thing. It's not saying there are no benefits. It's saying that I think that the costs outweigh the benefits. And that's the way I feel about the debt ceiling, is that we have this tendency just to keep borrowing and borrowing and borrowing. And it's the one thing that's possibly keeping us from a different disaster. But it's a judgment call.
I want to also get back to actually something that Chari mentioned in the questions here. These demographic time bombs. So, many of us have seen those projections of Congressional Budget Office in terms of debt to output in the United States, government debt to output, projected to increase a lot. And I think that is, of course, because of the population aging and health expenditures being very, very high. And you see those projections, and then you say, well, maybe 100% of GDP is okay, maybe 200, maybe 300. I mean, it keeps going. So I don't know the process by which, what the process is to shape or discipline or change those potential paths in our political process. Maybe the debt limit is one component, but those projections are certainly, potentially worrisome. And I think that's what you're also alluding to, Shetel. Maybe that limit ceiling is one piece. I mean, there might be better ways for sure, because these sort of risks of potential technical default with bad consequences because of this polarization in our political system is costly as well. But those projections in terms of the long, more medium term, long run, those are certainly, they gives you pause.
We have 1 minute to go. I want to each make a final statement, and then we close the webinar.
I've done a lot of talking. I'll let Marco and Cristina go.
So I'll say this is connected to this last question. I think simple, clear rules, probably in the Constitution, because that way they're harder to change, would be a good idea. There's plenty to talk about exactly what rules, but these fuzzy rules where we don't know exactly what's going to happen are probably not the best way to ensure fiscal discipline. They're better than nothing. They're not the best way.
I think we'll let that be the last moment today. I want to, or you want to say close, Christina? No.
I mean, I want to maybe just say that I think that for me, the two output of 100% for the United States does not seem so high. And I think at this point, sort of some agreement on with our political process is important, because the consequences of a potential technical default can be very high.
Thank you. I want to end by saying that HHEI, Haile Hurwitz Economic Institute, has a podcast. This webinar will be available there. We have one podcast coming out every Wednesday. Today's podcast is by former president of the Federal Reserve Bank of Minneapolis, Gary Stern, talking about the banking crisis. It's a fantastic episode. I encourage you to see it. Good night, everybody.